Howdy, Jacob here. Today we're looking at Infosys Limited in the IT services industry. 81 billion market cap on a little bit less enterprise value. Incorporated in 1981. We do see that between 2001 and 2012, it looks like the return on invested capital fell quite a bit. But for the last 10 years, it has actually been pretty flat, growing a little bit recently, so that's pretty great to see. Revenue is over double what it was 10 years ago. Gross margin is actually down 5% and operating margin down 3%. So that is a little bit concerning. Not concerning, not terribly concerning, because I mean, you're still having 21% operating margins. That's pretty fantastic. But the fact that's going down um, might show that it's not quite as moat like as it might be. And then ROIC is going up and as high as 28%, which is great. But the margins going down is not entirely attractive to me. About 2.2 billion cash and short-term investments with zero short-term and long-term debt. Extremely safe company from a balance sheet perspective, and then from a free cash flow perspective, again, very safe. They're producing cash flow like absolutely crazy. Their capital expenditures are actually lower than 10 years ago. Um, that's insane. So free cash flow or cash from operations is about 50% higher, and their capital expenditures are lower. So they are gushing out cash, with their use of cash being maybe 5% acquisitions, 20% reinvestment, paying the dividend. Are they still paying? Okay, that dividend of 1.7 billion is paying out roughly 55%, and then recently buying back a lot of shares. So historically, they've been paying this dividend for quite a while, um, but their use of cash. Otherwise, they do use a little bit of cash to repurchase shares, make acquisitions, and reinvest back in themselves. So let's look at making some assumptions for this company. On the revenue side, based on their acquisitions and being able to reinvest at possibly these 20% rates of return, I'd say that I would not be surprised with an 8% revenue growth. Um, I'm going to put 18 on the P in price to free cash flow just because margins going down is a little bit concerning to me. So I'm not going to put it quite as high as some of the others that have had this growth rate that I think will have similar growth rates at the end of 7 years. For margins, let's do 18 and 19%. Well, let's switch that. Not like it matters, but 19% on the net income margin side, 18% free cash flow margin side, and then let's say that they buy back 0.5% of their shares. Dividend, I think that they can increase that a little bit. Let's increase it a 3%. So then at the end of 7 years, maybe the payout ratio goes to about 45%, which is more so what I'd want for a company with that high rate of return on investment. But for me right now, again, just looks a little bit expensive like a lot of these other ones. A fantastic company. I am a little hesitant on those margins declining, saying that it's like, you know, a super moat company, but I do think that there's a lot of growth potential here. I think they've historically shown that they're very good at, uh, getting good rates of return. But again, everything you buy, everything is the price you pay for it. And so to me, it's just a little bit expensive at the moment. Hopefully you enjoy the video and have a great rest of your day. Thank you.